When you're trying to make sense of your finances, it can really feel like you're wading through just this endless ocean of information.
It really can. Overwhelming.
Yeah. So our goal with this deep dive is to, well, hand you the essential tools, the key insights, so you can feel genuinely informed, without drowning in all the details.
Exactly. And today, we're plunging into really a foundational text in investing. Benjamin Graham's The Intelligent Investor.
The classic.
The absolute classic. We'll be using bits from the revised edition, which crucially includes commentary by Jason Zweig.
Ah, yes. Zweig's updates are so valuable.
They really are. They help pull out that core wisdom and show how it's still incredibly relevant for navigating today's markets.
Okay, so think of this as your maybe express route to understanding intelligent investing. Our mission is to unpack those core principles.
Right. We want to look at things like the difference between investing and speculating, a huge one for Graham.
And Mr. Market. Love that analogy.
Oh, yeah, Mr. Market. And, of course, the margin of safety. Can't talk Graham without that.
Absolutely central. Then there are the two investor types he identified.
The defensive and the enterprising,
Yeah.
Plus, the huge role of emotional control.
Oh, definitely. Temperament over IQ.
Yes, the one. We'll also touch on, figuring out a company's real value, the importance of dividends, and even how inflation fits in.
And Zweig's modern take on all this, how he connects it to today.
Precisely. How it all offers this timeless framework for your financial decisions. Ready to jump in?
Let's do it. So where do we start? Investing versus speculating.
Absolutely. Let's kick off right there. Graham saw this distinction as, fundamental, critically important.
Okay, so let's unpack this. For Graham, investing is. It's about thoughtful decisions, right? Backed by solid analysis.
The main goals are, first, protecting your initial money safety of principal, he called it.
Safety first.
And second, getting a decent and adequate return. It's, deliberate, needs research.
Right. And speculating then is what? More like guessing.
Pretty much. It's buying based on, say, market trends or hype, or maybe just a gut feeling, without really digging into the underlying value.
Buying because it's going up, hoping it keeps going up.
Exactly. And what's fascinating is Graham's focus on the mindset. He saw the investor as basically a business owner.
Thinking like an owner, not just a stock trader.
Precisely. Concerned with the company's health, its value. The speculator, they're mostly trying to guess price moves.
And Graham really warned about mixing those two up, didn't he? Especially when markets are hot.
Oh, absolutely. He was very concerned about people who were essentially gambling, but told themselves they were investing.
Easy to do in a bull market.
Very easy. He wanted to arm people against that kind of, self-deception.
Right. It's so easy to get swept up and think you're a genius when really the tide's just lifting all boats. Okay, speaking of market ups and downs, Mr. Market. This has to be one of Graham's most brilliant teaching tools.
It really sticks with you, doesn't it? He paints the stock market as this kind of emotional business partner, Mr. Market.
Your slightly unstable partner?
Exactly.
Yeah.
Every day he shows up, offers to buy your share of the business or sell you his share.
Okay.
But the key thing is his mood is all over the place, wildly volatile.
Right. Some days he's euphoric.
Totally giddy, offers you crazy high prices. Then the next day, he's duply depressed.
Practically giving the shares away.
Almost.
Yeah.
And he's offering to sell his shares for, pennies on the dollar, metaphorically speaking.
So here's the kicker for you, the listener. Graham's point isn't that Mr. Market knows best.
Far from it. That's the crucial lesson.
The real takeaway is you don't have to listen to him. You can just ignore his daily mood swings.
Exactly. You have zero obligation to trade with him just because he showed up feeling manic or depressed. Remain detached.
Connect that to our strategy then. Emotional discipline.
That's the core. Don't get swept up in the market's euphoria. Don't panic when it tanks.
Use his moods instead.
Precisely. View his extreme pessimism, when prices are low, as a potential buying opportunity. Get good companies cheap. And his crazy optimism. Maybe that's a signal things are overpriced. Perhaps a time to consider selling if valuations seem, detached from reality.
So you use his volatility to your advantage. You don't let it control you.
Yes. Treat the volatility as information, maybe opportunity, definitely not as instruction. Mr. Market's moods are for you to potentially exploit, not follow.
Okay, so the advice is stay cool, stay detached. Don't let the market's drama run your long-term plan. Makes sense. Now let's move to what Graham called, the cornerstone, the absolute bedrock, margin of safety.
Yes, margin of safety. If there's one central concept, this is arguably it. It's fundamental for protecting yourself.
Think of it like a buffer, a safety net.
Exactly. It's that crucial cushion between the price you actually pay for something and your careful, conservative estimate of its real underlying value.
It's intrinsic value.
It's intrinsic value, yes.
So give us an example. Like if you analyze a stock and figure it's worth, say, $100 a share.
Graham would say don't pay $100 for it. Not even $95 probably.
You need a discount.
A significant discount. Aim to buy it maybe, I don't know, $70, $80? Maybe even lower if you can.
And that $20, $30 difference?
Yeah.
That's the margin.
That's your margin of safety. It's like buying insurance on your investment decision.
And it's not just about getting a bargain, is it? It's about protection.
Absolutely. Protection against all sorts of things. Maybe your analysis was a bit off. We're all human.
Right. Or the market just goes crazy for a while.
Or the company hits an unexpected rough patch. That margin acts like a shield.
It absorbs the shocks.
It absorbs shocks, reduces the chance of a big loss if things go wrong, and increases your odds of getting a satisfactory return even if things aren't perfect.
It's defensive driving for investors. Leave extra room.
That's a great analogy. It's not about maximizing every last potential dollar of gain. It's about minimizing the risk of serious loss.
Okay, building resilience. Got it. Now, Graham knew not everyone invests the same way, right, or has the same time. So we talked about two types.
That's right, the defensive investor and the enterprising investor.
Let's start with defensive. Who's that for?
The defensive investor. Their main goal is really capital preservation, avoiding big losses, and getting, acceptable returns without a ton of effort or worry.
Okay, simple, safe, steady. What do they actually do?
Well, the cornerstone strategy is broad diversification. Don't put all your eggs in one basket.
Spread it around.
Spread it around. Mix stocks and maybe some high-quality bonds. Graham liked low-cost index funds for this. Gets you diversification easily.
Makes sense. No need to pick individual stocks if you don't want to.
Right. If they do buy individual stocks, focus on large, established, financially strong companies, ones with a long history of profits and paying dividends.
Boring but reliable?
You could say that. And finally, just occasionally rebalance. Bring things back in line if one part grows way faster than another.
So this sounds perfect for someone who doesn't have tons of time or maybe doesn't feel like an expert stock picker.
Exactly. If you lack the time or maybe the inclination or even the deep analytical skills for intensive research, the defensive approach is probably very suitable.
Okay. Practical.
Yeah.
Now the other side, the enterprising investor, what's their deal?
The enterprising investor is more ambitious. Their goal is actually to beat the market average.
Higher returns.
Higher potential returns, yes. But it requires much more effort. They're willing to put in the time and the hard work doing deep research.
Looking for those hidden gems.
Looking for undervalued stocks, market inefficiencies, things the average person or even the defensive investor following simpler rules might miss. Requires real fundamental analysis of individual companies.
But this is where Jason Zweig adds that important note of caution, right?
Oh, absolutely. Zweig's commentary here is, I think, essential. He provides a crucial reality check.
What does he say?
He reminds us that being a successful enterprising investor takes serious discipline, a lot of patience, and real honed analytical skill. It's not easy.
So don't just jump in thinking you'll beat everyone else.
Exactly. Zweig strongly warns against chasing higher returns down this path if you don't really have the dedication, the interest, and, frankly, the aptitude for that deep dive.
You could end up doing worse.
You could easily end up doing worse than just taking the simple defensive route. It's a really powerful reminder to be honest about your own capabilities and your commitment level.
That's super important. Match your strategy to who you are. Now, whether you're defensive or enterprising, Graham hammers home the need for emotional control.
Yes, this is huge for him. He famously said something like, your temperament is much more important than your IQ for investment success.
So being smart isn't enough if you panic easily.
Precisely. He saw tons of intelligent people fail as investors because they couldn't control their emotions. Their feelings overrode their brains.
What kind of emotional mistakes did he pinpoint?
Oh, the classics. Like panic selling when the market drops.
Selling low out of fear.
Or the opposite, getting way too confident, taking crazy risks when everything's going up.
Buying high out of greed.
Right. And just chasing fads. Jumping on whatever's hot because you have FOMO, fear of missing out.
Those emotionally driven moves can wreck your results.
They really can undermine any sound strategy.
And Graham had that great quote, something like, satisfactory results are easier than you think.
But superior results are harder than they look. Yes, that's it.
What does that really tell us?
Well, it suggests that a steady, disciplined, rational approach, mainly focused on just avoiding big mistakes, is often enough to reach your financial goals.
You don't need to hit home runs all the time.
Exactly. Whereas constantly trying to beat the market to get those superior results is a much tougher game than most people realize. More demanding, less predictable.
Okay. Now, underpinning all this is Graham's focus on intrinsic value, on fundamental analysis. Can you break that down, make it click?
Sure. Intrinsic value. It's essentially the true underlying worth of a company, what it's really worth based on its business reality, completely separate from its, often jumpy stock price.
So how do you figure that out?
Graham said you need to analyze the company like you were thinking of buying the whole thing, the entire business.
Okay, so look under the hood.
Exactly. Dig into the fundamentals. Things like its earnings, is it actually profitable? What are its assets worth? Does it pay dividends consistently?
How strong is its financial health? Like debt levels?
Yeah, balance sheet strength, debt. And what are its long-term prospects? Its competitive position in its industry.
So you do all this work to estimate that intrinsic value.
And then compare it to the current market price. The goal is to see if the price is significantly below your estimate.
Creating that margin of safety we talked about.
Precisely. For example, an enterprising investor might look at something like the price to earnings, the PE ratio, compare the stock price to the company's earnings.
If it's low compared to history or peers, maybe it's cheap.
It might be an indicator of undervaluation, yeah.
Yeah.
But it's just one piece, of course. You need the whole picture.
So the big insight here for you, the listener, is don't just watch the stock ticker. Understand the business.
Yes. Remember, Warren Buffett, Graham's most famous student, always says, price is what you pay, value is what you get.
Love that. Value is what matters.
That's the Graham philosophy in a nutshell.
And dividends seemed pretty important in his view of value, too.
They were. He definitely had a preference for companies with a solid, consistent record of paying dividends.
Why was that so important to him?
Well, for Graham, a steady dividend history was often a sign of a mature, financially healthy, well-managed company.
Okay, a sign of stability.
And it gives investors a tangible return, actual cash in hand, regularly. It doesn't rely solely on the stock price going up, which can be, unpredictable.
Provide some income along the way.
Exactly. And that steady income can help you, the investor, stay focused on the long term, on the company's value, rather than getting spooked by short-term price swings.
It's like the company sharing its success directly with the owners.
That's a good way to put it. Sharing its ongoing success with shareholders.
Makes sense. A concrete benefit. Okay, let's shift gears slightly. Inflation. That's always a worry. Did Graham address that?
Oh, yes. He definitely recognized that inflation, the way prices generally rise and your money buys less over time, can quietly eat away at your returns.
The silent thief?
Kind of, yeah. He warned against holding too much in assets that don't yield much, like traditional bonds or just cash in the bank, especially when inflation is high.
Because their real value goes down.
Right. Your purchasing power erodes. He suggested diversification, including stocks of strong companies, as one potential way to help combat this.
And caution with long-term bonds when inflation is up.
Yeah, be cautious with long-term fixed income stuff then. The key is realizing your returns need to beat inflation just to stay even in terms of what you can actually buy.
So be aware of that hidden inflation tax and position yourself to try and outpace it.
That's the idea.
Okay, so Graham wrote the original book decades ago, which makes Jason Zweig's commentary in the newer editions really vital for us today, doesn't it?
Absolutely vital. Zweig does a brilliant job bridging that gap, connecting Graham's timeless ideas to, well, the modern world we actually invest in.
How does he do that?
He adds updated footnotes, lots of insightful commentary, and really relevant examples. He links Graham's principles directly to things like, the dot-com crash.
Right, bubbles and busts.
Other market panics, and also, importantly, the whole field of behavioral finance.
Understanding our psychological biases.
Exactly. The stuff Graham intuitively understood and warned about, behavioral finance now studies scientifically. Zweig weaves that in.
And I bet those real-world, more recent examples make Graham's ideas feel much more concrete and usable today.
They absolutely do. By showing how these principles played out during, say, the 2008 crisis or other recent events, Zweig makes them far more relatable.
Helps you see how to apply them now.
Yes. He effectively shows that the basic human emotions, fear, greed, and the market cycles Graham saw way back then are still driving things today, despite all the changes.
Which just underscores how incredibly timeless Graham's core wisdom really is.
It really does.
I mean, think about all the changes. ETFs, robo-advisors, crypto, meme stocks, all this new stuff. But these fundamental principles, they still apply, don't they?
They absolutely do. Because value investing, the way Graham taught it, isn't really about the specific tools or the latest trends.
It's about the approach.
About the approach, the discipline, the analysis, the long-term perspective. It's about understanding value, insisting on that margin of safety, and controlling your emotions.
Those things don't go out of style.
They don't.
Yeah.
Because they're rooted in, well, basic economics and human psychology, which don't fundamentally change just because we have smartphones now.
So as we wrap up this deep dive into the intelligent investor, what are the absolute must-remember takeaways for our listeners?
Okay, key takeaways for you, the listener. First, really internalize that difference between investing rational, analysis-based, and just speculating.
Know which game you're playing.
Exactly.
Okay.
Second, learn to see Mr. Market's volatility not as a threat, but as a potential source of opportunity if you keep your head.
Use his moods. Don't be used by them.
Right. Third, margin. Safety. Always. It's your primary defense. Build it into every decision.
Non-negotiable.
Pretty much. Fourth, choose the path, defensive or enterprising, that truly fits you. Your time, skills, personality. Be honest with yourself.
Align strategy with reality.
Fifth, master your emotions. Temperament trumps IQ in this game. Work on staying rational.
Hard but crucial.
Sixth, focus on intrinsic value. Understand the business behind the stock price. Price is just noise sometimes. Value is real.
Got it. What else?
Seventh, appreciate dividends. They provide income and can be a sign of stability. Don't just focus on price going up.
And finally,
Always remember inflation. Keep an eye on how it affects your purchasing power and factor it into your long-term plans.
wow. That's a solid checklist. And it really feels like even with markets being so complex now, these Graham principles, especially with Zweig's modern lens, give you such a strong, reliable foundation.
They truly do. A durable framework for making smarter, more informed financial decisions that can serve you incredibly well over the long haul.
Which leads us, I guess, to a final thought for everyone listening.
Yes. A question for you to really mull over. Thinking about these core ideas, investing versus speculating. Mr. Market, margin of safety, emotional control, value, what's maybe one concrete thing, even a small adjustment you could consider making in how you currently approach your own investment decisions.
Food for thought, taking these timeless lessons and making them practical for your own journey.